I want to bring you in, Tom, because I think we're all wondering, okay, where should we be putting our money right now? Our viewers certainly want to know that. I want to bring up one that you had brought up before. You were on the show back in June, and you told us about Cooper Standard. It's an auto supplier. So why are you bullish on that?
Yeah, well, thanks, Kelly. Yes, on June 7th, I came on. Cooper Standard is now up 25%, even though the market's been down. They are the #1 in sealing systems globally, think windows and doors, #2 in fuel and brake delivery, and #3 in fluid transfer. They announced recently that they're going to complete a refinancing on January 18th. It's fully backstopped by JP Morgan. We think that's the first catalyst. We think this stock can be a double in 2023, a double plus, and a multi-bagger over years. Why do we think that? This happens every recession when they trough. We have 2 years of backlog for new cars. Used cars are going to do poorly in 2023. New cars, we have 2 years of pent-up demand. We think over the next couple of years, IHS thinks that industry volumes are going to get back to pre-pandemic levels. The company earned $7 a share at its peak. Based on those volumes, it's only trading at $7.50 a share right now. So you put a 10 or 20 times multiple as it's traded in the past. As we look out to 2023, 2024, and 2025, this can have meaningful upside moving forward.
I want to push you, though, in a follow-up on that, because you're saying, okay, the new car demand, right, it's been pent up for 2 years. But we're also entering a time where folks are tightening their belts, not wanting to spend as much. They might be losing their jobs. So do you really think that we are going to see a boom of folks going out and buying that new car, buying that new Tesla or whatever brand they're looking at?
Yeah, well, Kelly, we don't need a boom. We just need a normalization. Even if you see the unemployment rate tick up to 4.75%, that's below historic means. The average age of the car, 13.1 years, whether they want to or not, those cars are going to have to be replaced. Then you look at the infrastructure package, which hasn't even hit the market yet, the amount of F-150 trucks that are going to be on the road. We think that things are certainly going to normalize moving forward over the next year or 2 years. And the operating leverage in this business, if they can get to $3.50, $4 a share over the next couple of years, you put a 10 times multiple, you really have a high level return moving forward. So the key is they took the #1 risk off the table, which was the refinancing risk when announcing that transaction. That's now backstopped. It'll be completed in January, and we think we'll be back on in a few months with another gain to talk about in that stock, and we think it has a bright future.
Well, we'll certainly be looking at Cooper Standard. I want to ask you, Teddy, what are your gems? Is cash still king, or are there some stocks that, I and our viewers should be putting our money into?
Well, first of all, it's not all bad news, because for seniors, people like myself, retired folks, savers, this is a terrific environment, because you can get anywhere from 3.5% to 4% on your money, whether it's treasuries or money market funds, without any risk. So you don't have to basically deal with the stock market. So for some folks, what the current environment brings is very good news. On the other hand, the best trade still, as far as I'm concerned, I say cash is king, is the 3 months treasury. Because it is riskless, it's almost 4.5% on your money. Why stick your neck out when there are so many unknowns out there? But if you twisted my arm and you said, Teddy, well, all right, that's fine, but I don't care about that. I want to buy stocks. I think the first sector I would look at would be the insurance stocks, because clearly they have huge reserves and they benefit from an environment of higher interest rates. Second would be energy stocks, because I think energy is fine and I think it's going to work higher. But most of all, what we're doing this time of the year, and this is more for a trader, not for an investor, is every year at this time of year, we tend to look through the the lumps of coal, if you will, or stocks that are making new lows. Yes, fundamentals are important, but we look for stocks that are trading at their lows, and usually they're there for a reason, but at their lows and multi-year lows. And there's some very interesting names there,
sure.
Such as Medtronic, Tyson Foods, Elanco, and there are at least dozens more. And the difference between this year, it's harder this year than last year, because this year the markets have been so bad, so you have a lot of stocks to choose from. This is a much better strategy when you have a good market, like you ended 2021 in, because then the stocks that are not acting well are easier to find.
Yeah. All right. So lumps at coal. We're gonna find the diamonds out of there.
That's
But I was
right.
just looking. I mean, the 3-month Treasury, almost 4.5%. That's a good point. But thank you, Teddy Weisberg and Tom Hayes. We really appreciate you joining us. All right. Well,
Thanks,
while
Kelly.
Southwest